like I said before, it has to be a no-brainer. It has to be that much better. So it's almost, and that's why it's taken so long to get to this point, because where we are today is we're approaching parity. So for today, let me just pull up my numbers so I'm totally up to date. So term SOFR is already trading down to about 4.5%. So if we were to borrow, let's say, a 7-year loan, the 7-year US Treasury is 416. So there's pretty good gap there, 416 versus 450 on SOFR. But we feel pretty good about a rate cut coming in December, so that would put SOFR at about 425. So you can see, assuming an equal spread, just for simplicity, your starting interest rate on the floater is about the same as your fixed interest rate on the fixed rate. Okay. So basically, if you believe that we are in an easing cycle and that the Fed is going to be cutting rates over time over the next year or two, and you have a starting rate that is about the same as the fixed rate today, then why wouldn't you just float and get the potential benefit of the easing cycle rather than just fixing and then that's it? Like, you're stuck. Like, you've got your fixed rate, it's where it's at today, and that's it for the whole loan term. Meanwhile, if you float, okay, your rate is about the same, and then you have the opportunity for it to float down, which it pretty much 90% chance it will float down. It's just a question of how much. Is it going to float down to expectation? Is it going to float down less than expected? Or is it going to float down a lot more than expected, which is typically what happens, because typically after the Fed has raised rates so much, you end up in a recession. And then once unemployment kind of spikes, then the Fed just starts cutting like crazy to try to stimulate us out of it. So there's a chance that rates don't bottom, that SOFR doesn't bottom at 3.7, but bottoms at 2.7 or even 1.7.
Wouldn't that be nice?
I think it's very possible, because if you look at this from a long-term natural neutral rate perspective, those are confusing terms because I don't really know what the difference is, but the Fed basically does a survey every meeting for what the natural rate is.